Hello everyone. Burger King came out with its IPO a couple of weeks back, and since its listing, there has been a lot of retail investor enthusiasm in this stock. And it's not surprising because the IPO happened at 60 rupees. There was huge oversubscription. Most of the shares got allotted to institutional investors. Retail investors got very small portion, and most of the investors got nothing from the IPO. So after listing, it listed around 120 plus levels, and after listing, there has been lots of buying happening from the retail investors, and the share price did move towards 220, and so many people started jumping into it during that move. After that, after it hit 220 level, it has dropped a bit and has stabilized around the 160 170 range. Okay, for the last few days we can see it around that price range. Now in this video, I'll be sharing my frank opinion, okay, logic on what as a retail shareholder you should be thinking or expecting from Burger King shares. Okay, whether you buy more, sell your existing shares or hold on to your shares. Okay, you at the end of this video, you will know my frank opinion about it. Okay, so let's begin. Firstly, I just collated the annual report data from their website, and since FY16 they have the results announced on the website. So here it is, the main total income and total expenditure figures. I have created a chart for that representing those data. Now have a look, because this is a very interesting thing. The company, I think, started operations in FY14 or so. So it started maybe from a few stores at the beginning, and over the last 5 years they have expanded pretty rapidly. Means today they are said to have around 260 plus stores operational across the country. And as you can see, the revenues, the blue chart, just have a look. The blue chart, the revenues were around 140 crores in FY16, and it has been growing at a consistent pace, maybe around 30-40% per annum growth they are maintaining. And in FY19 it was 644, and latest FY20 figure is close to 850 crores. So the revenue growth is pretty good thanks to expansion of number of stores that is happening across the country. Maybe they are adding around 50 stores or so every year. Now look at the total expenditure figure. This is the interesting part. Now please listen to this very carefully, because this is something that most advisors have not told you about while suggesting to apply for the IPO. Now have a look at the expenditure figure. It has been always higher than the revenues between FY16 till FY18. Okay, as you can see, the total income figure is smaller than the total expenditure figure. Now remember, what constitutes the total expenditure right now? It constitutes mainly the raw material cost, okay, the food products that they sell, the raw material for that, the employee expenditure, the administrative and the logistical cost, and advertising cost. Okay, all these things are included in this total expenditure figure. It does not include the interest cost on the borrowings that they have made, okay, whatever they have made, and the depreciation cost. Okay, the depreciation figure is not included in this total expenditure figure. So between FY16 and FY18, if you see, the total expenditure figure has been higher than the total income figure. So that means Burger King was making a loss even on the operating front between these years. Now in FY19, if you see, the income figure has gone higher than the expenditure. It is 644 crores of income and 554 crores of total expenditure, as you can see. Now most analysts will start telling you that it is making operating profit from FY19 onwards, but let me tell you, that's not true. The reason why we can see the total income figure higher than the total expenditure for FY19 and FY20 is the new accounting standards. Okay, remember, till FY18, the lease rentals for the stores was a part of the total expenditure. Okay, till FY18, means for these 3 years, the lease rentals. So wherever they open new stores, they have to take a place on rent for a long-term rent, maybe 10 years, 20 years kind of lease agreement they make, and they pay an annual lease rental to the owner. So that lease rental was a part of the total expenditure for these 3 years. From FY19 onwards, thanks to the new accounting standards, the lease rental component has gone out of the total expenditure part, and it is now distributed between the depreciation and the interest cost. And that is the main reason why Burger King can be seen as reporting an operating profit from FY19 onwards. Okay, so here also it is made around 90 crores of operating profit, and in the following year, that is in FY20, it has made around 108 or 109 crores of operating profit, is what we can see from these figures. But that's not the truth. Let me tell you, the lease rental cost, if added to the total expenditure part, it is still making an operating loss. Okay, the expenditure is still a little higher than the total income. So don't get fooled by these numbers. That's the first warning that I wanted to share with you. Okay. Yes, as these stores mature, okay, as these stores are currently in their first 2 or 3 years of operations. So as these stores mature more and more, their sales from each stores gradually keeps increasing with every following year. Then one by one the stores will get profitable, and that's when the total income part will go higher than the total expenditure. So that is still some time away. Now, next, let's look at some important points that all shareholders of Burger King, whether they are already holding or whether they are thinking of buying shares of Burger King. So please note down these points very well. First and most important, as I mentioned, despite having expanded to 260 plus stores in the last 5 or 6 years, Burger King is still a loss-making company. Okay, that is a disappointing part. But this does happen to most companies who are expanding pretty rapidly. Okay, but now that it has reached a decent size, 260 plus stores is a decent size, and still it is a loss-making company. So that's a little disappointing part. The positive profit before tax. Now I'm mentioning deliberately the profit before tax because we have to consider the depreciation and interest component as well in the cost in the expenditure part, because lease rentals is a big cost for businesses like these. Okay, the quick service restaurant or any restaurant business as such, for them the lease rental is a substantial cost of operation. So we have to consider that while arriving at a profit figure. So profit before tax is the figure that most of you should look at. Okay, don't look at the EBITDA or the operating profit that the company announces or most analysts will tell you. Don't look at that. Look at the profit before tax figure. That is more important for you. Okay, so the positive profit before tax is not expected to happen on the next couple of years. It is definitely around 2 or 3 years away minimum, because it could get delayed depending on how the stores mature, how the businesses, how the revenues from each store grows, and how the company adds more stores to its chain. Okay, so that is an important part. So next 2 years at least, I'm not expecting a positive PBT. Now, average per store business, if you just do a rough calculation of the total revenues that they have currently and the number of stores operational, the average per store business is currently less than rupees 4 crores per year. Okay, now the total revenue of around 850 crores and the latest number of stores figure is 260 plus. So if we just divide it and assume that a year ago there were less number of stores, the average per store business is less than 4 crores per year. Now remember, the company is making an operating loss at per store level. Okay, most of the recently opened stores over the last couple of years are still making an operating loss. Maybe the stores that had opened maybe 3 years ago or 4 years ago, they have started breaking even on the operating front and maybe started generating a little bit of profit. So as more stores mature, okay, more stores start generating a higher amount of revenues from each store, then the profitability will improve. but currently it's at less than 4 crores of average revenue, and it needs to nearly double for this company to become profitable. Okay, the store to become profitable, the revenue should nearly double. Say at least 50 to 60% jump is definitely required. I'm saying nearly double, but minimum of 50-60% jump from the current level is definitely required for each store to become profitable. Now, stores expansion. This is something that the company will be planning now with the more capital at hand. So instead of adding more stores in new cities, they should focus more on expanding in clusters. Okay, so in few large cities, they can add more stores at different locations or in nearby cities, so that the administrative and the logistical cost becomes more utilized better. Okay, so it is more convenient to manage stores in a cluster rather than having stores at very far away places. So to help improve profitability, they should focus more on expanding stores in clusters. Now, as you all know that urban consumers, okay, those living in cities, they already have a lot of options in the restaurant space. Okay, the quick service format as well as the regular restaurants. So we have so many options, from pizzas to burgers to Indian dishes, and also so many different options. So the competition is quite tough in this space. So don't expect that new Burger King store opening and it will start generating huge amounts of revenue for the company. No, that doesn't happen. It takes time. It takes time to mature. So don't expect as stores expand, the company's profit will the company will start generating huge profits. No, that's not going to happen. It will take time. So their target is to achieve 700 stores in the next 5 or 6 years. That's possible. They can definitely add 50 to 70 stores every year, and they can reach that figure. But remember, all these stores need to mature, means they should be operational for at least 2, 3 or 4 years initially to reach profitability. So for the company to achieve the net profitability overall will take some time. That's why I've mentioned that minimum 2 or 3 years is the bare minimum that I'm expecting for the company to report a positive profit before tax. Now, the biggest negative for all shareholders, make note of this. Okay, this is a very big negative that you should definitely consider. The promoter sold a significant stake in the IPO. Now, why would a promoter sell his significant stake in the IPO at a price of 60 rupees per share? Just think about it. If you were an investor in Burger King and you had after the IPO, there was a possibility that the shares could list at something like 150 or 160 level. Then why would somebody sell it at 60 rupees a share? So just think about it as an investor. Okay, promoter is also an investor in the company. So if he's selling his stake, he sold nearly 16% of the company at just 60 rupees per share during the IPO. So what does that mean? That means that the company was pretty fairly valued at 60 rupees per share. The current business that they have, that was fairly valued, or maybe it was already at a slight premium to its current business size at 60 rupees per share. And today we can see people buying it at 170 plus level. So this is fairly obvious that it's not the correct thing to do. Okay, at 170 plus levels, you shouldn't be buying Burger King. Now, in any normal business, okay, in normal stock, if we see a promoter selling his stake, it is generally considered a big negative for that stock. Okay, whenever we see a promoter selling even 1% or 0.5% of his stake in the open market, we consider it as a big positive. And here we have seen the promoter selling 16%. He sold 6 crore shares of the company, which is nearly 16% of the overall diluted equity capital. So he sold 16% of the stake at 60 rupees per share, and today people buying it at 160 and 170 levels is fairly stupid, is what I feel. Okay, Burger King frankly, Burger King will grow, means the company's business will definitely grow. I'm expecting it to report an year-on-year growth of revenues in the range of about 20-25%. Maybe for the first year or so, might report even 30%. But overall, over the next 3-4 years, we can expect it to average out in the range of 20 to 25%. So from the current level of around 850 crores of revenues, we can expect the company to double in size over the next 3 years or at the most 4 years. This is what I'm expecting. It should reach that scale to become profitable. So net profit will be visible only by around end of FY23. So that is around 2 years or 3 years from now. That net profit may not be visible, or it might be, even if it does become visible, it will be very insignificant, a very small number. So a decent level of net profit will be seen only by the end of FY23 or beyond that, not before that. So please do consider all these points that I have shared today. If you are already invested in Burger King, please think about it. If you are thinking of buying Burger King shares today, please again consider all these points that I have shared. I think this share price will drop and it will be available in 2 digits sooner or later. It may not happen immediately because currently we are in a very bullish market, and but once there is some correction in the market, once things normalize, at some point, maybe in the next 1 year or so, at some point the Burger King share is definitely going to be seen in 2 digits. That is when you can start thinking of investing in this company again. This is a growth story, no doubt. This is a growth story, but be realistic with the expectations. At this price, it is overly valued compared to its business size and its business potential. Be realistic so that if it is available at half the price of what is it's trading today, say around 80 or 85 rupees a share, at that price, I would say that it is already factoring in the next 1 or 2 years of growth. So at 170, I would say that it is factoring the next 5 years or 6 years of growth. So this is not a price to invest at. Okay, it's already overvalued compared to its business size and its potential for the next 3, 4, 5 years.